Okay, just a little anticipation for you guys there. Now we'll get into accrued revenues. So these are defined. Oh, I don't like the red. I'm going to change that. They are revenues that have been earned but not yet invoiced or collected. So revenues that have been earned but not yet invoiced or collected. So they've not been recorded yet. Now remember, earned, we know that means that either the goods or the services have been delivered or the contractual agreement has met. So that has happened, but we haven't collected any cash or we haven't invoiced anything yet. And this happens quite often, that businesses actually do the work and they earn the money before they collect the cash. It's called doing work on credit or on account, as we've heard. And since this is earned, we need to recognize the amount. So when we accrue revenue, it's always going to create an asset, some type of receivable. So when we do this, we will debit a receivable of some kind. Typically, it's just going into accounts receivable. And we will credit a revenue. So either service revenue or sales revenue, depending if we're performing a service. If we're selling a good, maybe it's rental revenue. But some sort of receivable and revenue will be recorded. So again, we did see some of this in Chapter 2 when we booked accounts receivable. So we saw some questions there. We billed customers for services completed, or one might have said we performed services on account. So it's true, these type of entries could be recorded throughout the month. But what if a project isn't completed and therefore no bill has been done yet? But if we've performed partial services, we still have some type of revenue. So this is typically where we're going to be accruing these type of entries, where no invoice has been recorded yet. So if a bill hasn't been done, we haven't booked anything yet. But we need to recognize this, so we'll record this journal entry to accrue that. Okay, so let's look at an example of accrued revenue. HEC is hired on May 15th to provide monthly services for $3,000 per month, with the first payment to be received on June 15th. Services are provided from May 15th to May 30th. So we've provided these services for 15 days. Therefore, we're going to record this adjustment. We've recorded, or we've done half the work, we get to recognize half of the revenue. So again, I said here, we're always going to debit a receivable, credit revenue. So we will debit accounts receivable and we're performing a service, so we will credit service revenue. And as it shows here, we've done half the work. We're providing this for a month. We've done these first 2 weeks, so we will record this for half of that contract, $1,500. And by doing this, we're showing this concept of revenue recognition. We're recording it because it has been earned. Okay, so if we take a look at the T accounts here, we can see the amounts we've booked. So we've recorded the $1,500 of AR as well as this $1,500 in revenue. We've recorded half of the amount as that's what we have earned. So again, here, when we do an adjusting entry for accrued revenue, it updates the assets, the receivable, as well as the revenue. So we ask ourselves that question again, what if this adjusting entry was missed? What would the impact on the statements be? Well, we wouldn't have this balance here. So our asset would be understated. We missed recording that amount. And our revenue, again, that wouldn't be there. It would also be understated. And we know, because we've seen in the previous videos, if revenues are understated, net income is understated. And if net income is understated, our capital or equity account is also understated. Lots of impacts. Okay, so accrued revenues, we've earned it, but no cash yet. But what happens when we actually do receive this cash? So once the monthly services are completed, HEC is paid this $3,000 on June 15th. So we've got this cash, we need to record the journal entry for that. So this is really important that you remember what's already been booked and what is still left to be recorded. So first of all, we know we're getting cash. So we're going to debit our cash, and we're getting this full $3,000. Because the full month-long service has been performed, we get that full amount. This is what's important, that we have to think, okay, well, what has already been booked in our accrual? So we've already set up this AR for $1,500, and we've recorded half of the revenue. So the first thing that we need to do, now that we've received this cash, we have to decrease our accounts receivable. So we will credit that to get rid of that balance. We now have nothing left we need to receive because we've got the cash. But we also need to record the other half of the revenue because we've now done this work from June 1st to 15th. So we've earned the rest of this contract. So we're also going to credit service revenue for the rest of the amount that's been earned. So it's really important when you're doing these to think what's already been booked, what is left still to recognize. So we can't book a full amount to service revenue. We need to get rid of this AR and only book the half that hasn't been recorded yet. So if we update our T account for this, here we are going to have the credit to AR on June 15th because we received that. So now we have 0 in our receivable. There's nothing left we haven't collected. And we would have another credit to service revenue for $1,500. So our balance gets to $3,000. And we would also have a T account now for cash. So on June 15th, we recorded that full amount of cash. So our ending balances ends up with us having full recognized revenue and this full amount of cash and nothing left to still be received. Okay, so that is accrued revenue. There's another example waiting for you in the practice section, so go ahead and try that out.